Hello and welcome. Today we're working on the Introduction to Managerial Accounting. Now this is in the course Managerial Accounting or Principles of Accounting 2. If you're new, my name's Jeff from Finally Learn. We're teaching our way through the accounting series, and so we're in chapter 14 called Managerial Accounting, or sometimes books call them Introduction to Managerial Accounting or Managerial Accounting Concepts. Our next chapter is going to be job costing and process costing. So I've got a full selection of articles, videos, playlists to help you learn. So let's get started. So what we have is, at the very beginning of managerial accounting, we have just spent time with financial accounting. The first course you take is Principles of Accounting 1 or Financial Accounting. And so you learned things like rules, like Generally Accepted Accounting Principles or GAAP. You learned about the Financial Accounting Standards Board. You learned about the International Financial Reporting Standards, or IFRS, and the rules are set up by the International Accounting Standards Board. So lots of rules, lots of requirements. Those rules may change. Well, the goal in financial accounting is to issue financial statements. The time frame is historical. We have a report, a financial statement that it's from last year, and we report it and issue it, maybe in March of the next year or whatever. And so the audience is designed for public consumption. For the financial and investing public is the goal of financial accounting to issue financial statements to the public. Now, managerial accounting is a little bit different. Managerial accounting says, look, we don't really have rules. We have the same assets and liabilities and equity, but we're trying to figure out, is the benefit greater than the cost of producing these reports? And so our reports are for internal decision making, and so we try to figure out, what does our product cost? It is sometimes based on a budget, so not the historical use, but the current period and the future periods. What if we add more products? So we do some what-if analysis. And then the audience is for internal use. It's not public information. So managerial accounting is the extra information we need for decision making. Now, in managerial accounting, we have not only 3 levels of inventory, we have 3 product costs, and we'll go over those specifically, and then we're going to show how the flow of product costs go through the accounting system. Now, inventory, instead of just having inventory that we're ready to buy, that we buy and ready to sell, we have inventory that comes in as materials or raw materials, or sometimes we call these the big amount of materials direct materials. They go into building our products. And so we have materials before we get even started on a product. We have materials. So let's say we're a furniture company and we buy wood or lumber. Well, that is a direct material, and we haven't started working on it yet. As we start working on it, it becomes work in process. So anything that is work in process is things that have been started but not completed. And then when we finish them, they become finished goods, and they are complete and they're ready to sell. Now, a lot of times the examples in managerial accounting or cost accounting would be a factory-related idea. So you can kind of understand how that works. You have materials that go in, and then it becomes work in process, and then it becomes a finished good. Well, what type of product cost do we have? We have 3 general categories of product cost. And our product cost could be called manufacturing cost or factory cost. And so we have direct materials. That's the same as before, direct materials. And so then we have labor. We take materials. If we're a furniture company, we take wood and we add labor to it, and we're trying to produce furniture. And then we have overhead. So overhead would be MOH for manufacturing overhead, or FOH for factory overhead, or just simply overhead. So overhead is all the other things that are involved in producing in the factory. So it could be things like indirect materials, indirect labor. Now, we have the big categories: direct materials and direct labor. Indirect materials would be extra things you need. If we're making furniture, then you'd have some stain or some finish or you might have some glue. Well, those are important materials, but they're not a large cost, and they could use the same glue for lots of different jobs, lots of different products. So it's not specific for this one product that we're making. So you have indirect materials, direct materials is a category, but indirect materials is overhead. Direct labor is a category, but indirect labor is overhead. So also things like depreciation, things like taxes, things like utilities are all overhead. All right, so let's look at the flow of product cost. So here's what I've done. And just a way to think about the flow of product cost. Our three T accounts on the left-hand side here, materials and labor and overhead. So this would be the actual account as materials account. And then for labor, we would use wages payable. And then for overhead, we would use an overhead account, or MOH. So what happens is we buy materials, we have beginning materials and we buy more, and then we use some. Well, our direct materials go into work in process. As soon as we start working on materials, it becomes work in process. As we work on them and finish it, it becomes finished goods, and then as we sell, it becomes cost of goods sold. But let's look at each individual one here so you can kind of understand what's going on. Now, with the T accounts, I'm putting things in place that show the actual journal entry. So this is going to be helpful. So if we start using materials in the next chapter 15, I think it is, where we have job costing, then we'll say, hey, we used $300 for job 101. And so we'd move from materials into work in process. And so then we have indirect materials, and it goes over to overhead. So we use lumber, and we send it from materials to work in process. So this is direct materials used. It's the same idea. Direct labor used is the same idea. And MOH applied is how much goes into work in process. So as we start working on our products, it becomes work in process. Now we're going to have materials. We'll always have some lumber on hand, and so therefore we'll have ending materials. But the lumber goes into work in process here, and the glue goes into overhead here. Now wages payable, we're going to use, just make it simple, for direct labor, we're going to say this is wages payable. So we have direct labor used that goes into work in process. So these are the people that actually work on the product, and then indirect labor is overhead. So in a factory, we have other people that work in the factory that are not directly related, working on the furniture. Could be security and janitorial and supervisory. All those would be indirect labor. And then we have other things like depreciation, utilities, taxes. And at some point, we need to figure out how much does this product cost. And so we're going to use MOH applied. Now, MOH applied is an estimate, because we need to estimate now what our product is going to cost for overhead. And we have some basis of making the estimate. We have last month and the last several months. And so we put here MOH applied. And so we're working on our product, and it goes into work in process. Now, at the very end of the month or end of the period, we would have the actual overhead all coming in, and we have the applied, so that all the debits are the actual overhead, and all the credits are the estimated overhead. And we're going to be a little bit off. We'll either be over applied or under applied. If we over apply, then we've estimated a little bit too high. If we've under applied, we estimate a little bit too low. We can solve it by the next period. We'll adjust our estimate a little bit. So we have beginning work in process. We add materials, labor, and overhead. And we have ending work in process. And what we finish becomes cost of goods manufactured. So we finish, and it becomes cost of goods manufactured. Now, this is the cost of finished goods. We move it from work in process to finished goods account. We already might have a beginning balance of finished goods, And so we now have more finished goods available for sale. If we sell it, it becomes cost of goods sold. And this is the only point right here, is the only point where all these costs become expensed. So these are just product costs that grow our inventory, work in process, grow our inventory, finished goods, and then we end up with cost of goods sold, which is an expense on the income statement. All right, the next thing we'll do in this chapter is we'll work on how to calculate cost of goods manufactured and cost of goods sold. Hey, thanks for watching. Please like if this is helpful for you. Please subscribe, and we'll see you on the next video.